Today we're breaking down 5 dividend stocks with high dividend yield in 2025. I'll show you exactly how much passive income $1 million invested in each one would generate every month, when and how often they actually pay those dividends, and whether their businesses are healthy enough to keep those payments flowing. Because let's be honest, a big yield means nothing if the company can't sustain it. That's why we'll go beyond the headline numbers and look at the fundamentals that really matter. If your goal is financial freedom through steady, long-term dividend income, you're in the right place. So stick around until the end and don't forget to hit that subscribe button. Every week, we dive into practical strategies and investments designed to help you build lasting wealth. So first stock, let's start with Verizon. If you had $1 million invested here, you'd be collecting about $61,000 a year in dividends. That's roughly $500 every month. Money landing in your account without you selling a single share. And getting a little personal here, I know you're probably thinking, wow, $1 million is a lot in a single stock. I'll never get there. And I agree, $1 million in a single stock, which as we'll see later, isn't a huge growth stock. It's a stock intended solely to generate passive income safely. It's a big goal. Let's imagine that to invest $1 million in a single stock, you need a portfolio of about $10 million or more. That's a lot, right? But the point of this video is to give you some options to help you build a portfolio, because dividends are a great way to get rich when you reinvest. And here's where the real secret of dividends kicks in. Something I like to call the magic number. That's the point where your dividends aren't just paying you cash. They're actually big enough to start buying full shares of the stock by themselves. Take a simple example. If a stock trades at $25 and pays a 6% yield, then for every $5,000 you invest, 200 shares, you'll receive about $300 per year in dividends. That's enough to buy 12 more shares every single year without adding a single extra dollar out of pocket. And here's the magic. Next year, you don't just own 200 shares, you own 212. Those 212 now generate even more dividends, which buy even more shares. Over time, this cycle snowballs, creating exponential growth. This is why dividends are such a powerful wealth-building tool. Once you hit that magic number, the machine starts to feed itself, and every year your income grows faster and faster, even if you never invest another dollar. Personally, I started earning a little in dividends like anyone else. I started just a student, then I made enough to pay for a coffee, then dinner, then my modest rent, and today I earn a lot of money in dividends, around $70,000 per month. Well, but returning to the Verizon thing, this is one of the highest paying dividend companies in the US, with a current yield around 6.1%. Dividends come quarterly, and the most recent payment went out on August 1st, 2025. Now, big dividends are great, but only if they're sustainable, and Verizon's numbers show they are. The company pays out about 63% of its profits to shareholders and reinvests the rest into its business. Recently, management even raised its free cash flow forecast to as high as $20.5 billion for the year. That's a strong signal the company has the money to keep these payments flowing. And here's what makes it stand out. This isn't a new story. Verizon has increased its dividend for 21 years in a row, paying through recessions, market crashes, and every kind of turbulence the telecom industry has faced. Talking about risks, Verizon has lost some subscribers and its stock has lagged behind rivals like T-Mobile. Analysts rated a moderate buy with about 8 to 10% upside over the next year. Not massive growth, but steady. But I hope that if you choose to invest in this company, and making it clear that this is not a recommendation, you research it and keep it on your radar to see if it's doing well and if it's worth keeping your money there. Just like any other on this list, always be careful with your money. But well, Verizon isn't a stock that's going to double overnight. It's a stock that gives you reliable, predictable income month after month, the kind of consistency that can form the backbone of financial freedom. Now, second stock, Alexandria Real Estate Equities. ARE is a REIT, which stands for Real Estate Investment Trust. A REIT is basically a company that owns or manages real estate and pays most of its profits back to investors as dividends. Instead of buying an office building or a lab space yourself, you can buy shares of a REIT and indirectly own a piece of those properties. By law, REITs in the US must pay out at least 90% of their taxable income as dividends, which is why they usually offer higher yields than regular stocks. In simple terms, it's like a fund that collects rent and passes most of it straight to investors. In fact, here in Brazil, we have something very similar and which pays much higher dividends. It's funny to see 6% dividends being considered high in the United States, when in my country the dividends are around 12%. But of course, we have more risks and more inflation too. And well, Alexandria isn't a typical office landlord. It focuses on life science campuses and lab spaces in hubs like Boston, San Francisco, and New York. Tenants are biotech and pharmaceutical companies that usually sign long-term leases, making revenue revenue more predictable than in standard office REITs. At today's prices, RE yields about 6.5%. An investor with 1 million in shares would receive around $65,000 per year in dividends, or just under $5,500 per month. Dividends are paid quarterly at $1.32 per share. The company has increased its dividend for 16 consecutive years, though the latest quarter held the payout flat to conserve cash. Financially, AR generated about $3.1 billion in revenue and $309 million in net income in 2024, supported by nearly 44 million square feet of property. Its dividend payout ratio is around 57% of funds from operations, which is a normal level for REITs and suggests the dividend is sustainable. Management's decision to pause dividend growth reflects caution, not weakness. Valuation is depressed compared to history. The stock trades well below its peak and at a price to FFO multiple under its 10-year average. Analysts see 10 to 15% upside, though opinions are mixed. Some see a discounted opportunity, while others remain cautious about real estate sentiment. The main risks come from the environment it operates in. Biotech funding cycles can affect demand for lab space, and high interest rates weigh on property values across the REIT sector. In short, AR offers a high-yield, stable niche properties and a sustainable payout ratio, but faces the same macro pressures as the broader real estate market. It's an income-heavy investment, not a growth story. From now on, the video will be faster, and I will give you the essential information so I don't make the mistake of saying a lot of boring stuff. The third stock is Pfizer, one of the biggest pharmaceutical companies in the world. Right now, it stands out for its 6.8% dividend yield. A $1 million investment would generate about $68,000 a year, or roughly $5,600 every month, paid quarterly. Pfizer's latest earnings beat expectations, $0.78 per share on $14.65 billion in revenue, and management raised full-year guidance to as high as $3.10 per share. Key products include Vyndaqel, Eliquis, Padcev, and the COVID treatments Paxlovid and Comirnaty. The company is also targeting $7 billion in cost savings by 2027. The risk is the dividend payout, which is close to 90% of earnings, leaving little room if profits drop. Patent expirations and political pressure on drug pricing also add uncertainty. In short, Pfizer delivers one of the highest yields in big pharma and solid near-term results, but it's best viewed as a high-income, higher-risk stock rather than a safe growth play. The fourth stock is Healthpeak Properties, and this one is different because it pays every single month. At today's yield of about 6.9%, a $1 million investment would bring in around $69,000 a year. That's close to $5,750 every month, hitting your account like a paycheck. The current dividend is about 10 cents per share per month, with the next payment scheduled for September 30th, 2025. The dividend coverage looks reasonable, with payouts using about 70% of cash flow, healthier than many REITs, and analysts see potential here, with price targets suggesting up to 20% upside from where the stock trades today. But there's a catch. Healthpeak has cut its dividend before, which shows it can feel pressure, and as a healthcare REIT, it depends on occupancy and funding in the healthcare sector, factors that can shift quickly with the economy. So here's the bottom line. Healthpeak Properties gives you steady, above-average monthly income and the possibility of growth, but you need to accept the risk that those payments aren't as bulletproof as they look. But the dividend on this stock is really interesting. It's the highest on the list so far. Well, last but not least, Realty Income is known as the monthly dividend company, and it lives up to the name. With a dividend yield of about 5.5%, a $1 million investment would generate around $55,500 a year in dividends, or about $4,600 every month. Unlike most dividend stocks that pay quarterly, Realty Income pays investors every single month. The company has paid over 650 consecutive monthly dividends and increased its payout for more than 30 years in a row, making it one of the most reliable income stocks in the market. Growth has come from consistent portfolio expansion. Today, Realty Income owns more than 15,600 commercial properties, and in recent years, it has expanded internationally, adding assets in the UK and Spain. From 2019 to 2024, its adjusted funds from operations, AFFO, grew by nearly 245%, providing the cash flow needed to keep supporting dividend increases. Analysts are more cautious on the stock. The consensus 12-month price target is around $61, which represents about 5 to 6% upside from current levels. The shares trade at roughly 13 times FFO, a discount to peers, but also reflecting the pressure of higher interest rates. The risks are clear. As a REIT, Realty Income carries a lot of debt, so higher interest rates push up financing costs. And while most tenants are stable, weaker retail spending or broader economic slowdowns could affect rental income. In short, Realty Income offers stable, predictable income with monthly payouts and modest, long-term growth, making it one of the most consistent dividend payers available, though growth in the stock price itself is likely to remain gradual. Leaving final considerations here, dividend stocks can really make you rich in the long run, but you have to be consistent. If you are consistent in your contributions, studies, and analyses, you cannot fail. That's it, cousin. Stay invested.